Let's talk about something that sounds simple but is unbelievably powerful. Your circle of competence. Charlie Munger built his entire investing philosophy around this idea, not around predicting the future, not around being the smartest guy in the room, around knowing exactly what he understood and what he didn't. That sounds almost too basic, but it's not, because most people don't fail from lack of intelligence, they fail from overconfidence. Here's the core idea. Your circle of competence is the area where you truly understand how things work, not where you've read a few articles, not where you watched 3 YouTube videos, not where you feel confident, where you actually understand the mechanics, the incentives, the risks, the long-term dynamics. It doesn't have to be large. Munger was very clear about this. The size of your circle doesn't matter. The key is knowing where the edges are. That line alone separates amateurs from professionals. Most people don't know where their knowledge ends, and that's dangerous, because when you don't know where your edge ends, you step into territory where you're guessing, but you think you're reasoning, and that's where big mistakes happen. Let's make this practical. Imagine someone who works in the restaurant industry for 10 years. They understand food costs, margins, customer behavior, location risk, staffing issues. They've lived it. That's a circle of competence. Now imagine that same person suddenly starts investing heavily in biotech startups because they heard about big upside. Do they truly understand drug approval pipelines, clinical trial risk, regulatory timelines, scientific failure rates? Probably not. But the market makes it feel accessible. Information is everywhere. Opinions are everywhere. Confidence is everywhere. And that's the trap. Access to information is not the same as understanding. Munger avoided industries he didn't understand, even if they were booming. During tech bubbles, during hype cycles, during manias, he was comfortable saying, "I don't know enough." That level of humility is rare, especially in a world where everyone feels pressure to have an opinion. Here's something subtle. Your brain hates saying, "I don't know." It feels weak, it feels slow, it feels like you're missing out. So instead, we rationalize, we convince ourselves we understand enough, we blur the boundary. That's how circles expand artificially, not through learning, but through ego, and ego is expensive. The circle of competence concept protects you from yourself. It forces you to ask, do I really understand how this makes money? Do I understand what could destroy it? Do I understand the incentives of the people running it? If the answer is vague, you're probably outside your circle. Now, here's the powerful part. You don't need to understand everything. You only need to understand a few things deeply. Munger and Buffett didn't invest in hundreds of industries. They focused on areas they could evaluate rationally: consumer goods, insurance, businesses with durable economics. They stayed in lanes where they had clarity. And when something fell outside that lane, they passed. Passing is underrated. Most people think success comes from saying yes. Often, it comes from saying no. No to what you don't understand. No to what feels trendy but unclear. No to what requires you to pretend. Here's another layer. Your circle of competence isn't just about investing. It applies to career decisions. If you deeply understand a particular industry, how value is created, where margins are made, what customers care about, you have an advantage. But if you constantly jump into new spaces without building depth, you stay shallow everywhere. Shallow knowledge feels productive because it's fast. Deep knowledge feels slow. But deep knowledge compounds. When you operate inside your circle, decisions become clearer. You're not guessing, you're evaluating. When you operate outside it, you rely on hope, hype, and external validation. And hope is not a strategy. Now, an important clarification. Circle of competence does not mean staying small forever. It means expanding intentionally. There's a difference between gradual expansion through real learning and sudden expansion through excitement. If you want to expand your circle, you study, you observe, you test small, you build understanding over time. You don't jump from zero to expert because something looks profitable. Munger spent decades building multidisciplinary knowledge: psychology, economics, mathematics, history. That's how his circle expanded, slowly, deliberately, not reactively. And here's why this matters so much. When you stay within your circle, your error rate drops dramatically. You might not catch every opportunity, but you avoid catastrophic mistakes. And avoiding big mistakes is often more important than catching big wins. Think about that. If you avoid one massive loss, you protect years of compounding. If you chase one opportunity outside your circle and it collapses, you reset progress. Circle of Competence is a risk management tool disguised as humility. It protects long-term thinking because long-term compounding only works if you survive, and survival depends on not doing things you don't understand. There's also psychological peace inside your circle. When volatility hits, you don't panic as easily because you understand what you own. When headlines scream, you're less reactive because you understand the fundamentals. Clarity reduces fear. Confusion amplifies it. Most panic happens outside competence. So here's the real question. Where is your edge? Not where you wish you had one, not where social media says the opportunity is. Where do you genuinely understand the moving parts better than average? It could be a specific industry, a type of business, a skill set, a market niche. It doesn't need to impress anyone. It needs to be real. Munger once implied that knowing the edge of your competence is more important than expanding it rapidly. That's discipline. That's restraint. And restraint is rare, especially when the world constantly tempts you with the next big thing. But the next big thing is irrelevant if you can't evaluate it rationally. So instead of asking, "What's hot?" ask, "What do I truly understand?" That question slows you down, but slowing down inside your circle often speeds you up over time because clarity compounds. Confidence built on understanding compounds, while overconfidence built on ignorance eventually collapses. Circle of Competence is not about limiting ambition, it's about directing it. Stay inside what you understand, expand carefully, say no often, and let depth, not excitement, drive your decisions. That's how you protect compounding, and that's where real advantage begins. All right, now let's talk about the real danger: overestimating what you know. If part 1 was about defining your circle of competence, part 2 is about why most people think their circle is bigger than it actually is. And this is where things get uncomfortable, because almost nobody believes they're overconfident, but overconfidence is one of the most studied, most proven psychological biases in the world, and Charlie Munger talked about it constantly. Here's the problem. The modern world gives you access to unlimited information. You can read threads, watch interviews, listen to podcasts, scroll analysis, follow experts. After a few hours of consuming content, you feel informed. But feeling informed is not the same as understanding. Understanding means you can explain the mechanics clearly, you can identify risks, you can predict second-order consequences, you know what would make you change your mind. Most people don't go that deep. They borrow confidence from others. That's not competence, that's proximity to information. And proximity is dangerous because it creates an illusion of mastery. Let's make this real. Someone watches a few videos about commercial real estate investing. They learn some terminology: cap rate, leverage, cash flow, appreciation. Now they feel comfortable discussing it. But do they understand regional demand cycles, interest rate sensitivity, tenant risk concentration, liquidity constraints during downturns? Probably not, but the language gives them confidence. Language is not knowledge. Munger understood this deeply. He knew that humans are wired to overestimate their abilities, especially in complex systems, and investing is a complex system. So is business, so is career strategy, so is macroeconomics. Here's another trap. Success in one area creates false confidence in another. You're successful in tech, you assume you understand commodities. You're good at sales, you assume you understand capital markets. You made money in a bull market, you assume you're skilled. That's called outcome bias. When results are good, we assume the decision was smart, but sometimes the environment carried you. During rising markets, almost everyone looks confident. During bubbles, almost everyone feels like a genius. That's when circles expand artificially, and when the environment shifts, reality exposes the boundary. This is why Munger emphasized staying within competence even when it's boring, because boredom protects you from ego-driven expansion. Now, let's talk about a deeper layer, Dunning-Kruger. When you first learn something, your confidence spikes. You know just enough to feel smart, but not enough to see the complexity. Then, as you learn more, confidence drops because you start seeing how much you don't know. That dip is where real competence begins. Most people never go through the dip. They stop at surface-level understanding and move on. They expand their circle without deepening it, and that's fragile. Here's a simple test Munger would implicitly apply. Can you explain the downside better than the upside? Most amateurs can explain why something will succeed. Few can articulate why it might fail. If you can't clearly outline the risks, you're probably outside your circle. Real competence includes understanding failure modes. It includes knowing what could break the model. Overconfidence ignores fragility. Competence studies it. There's also social reinforcement. If everyone around you agrees with your view, your confidence increases. But agreement doesn't equal accuracy. Echo chambers inflate circles artificially, especially online. You see hundreds of people bullish on the same asset. You assume collective intelligence, but often it's collective emotion. Munger avoided groupthink by being willing to look wrong in the short term. He didn't need social validation, and that's critical because social validation expands perceived competence. Independence shrinks it to reality. Here's the dangerous part. Overestimating your circle doesn't just reduce returns, it increases risk. Because when you think you understand something deeply, you allocate more capital, more time, more identity. You size up. And if you're wrong, damage scales. This is why humility is a competitive advantage. Humility keeps your circle honest. It keeps position sizes rational. It keeps you cautious where you should be cautious. But humility feels uncomfortable, especially when others appear confident. Confidence sells. Humility rarely does. Yet long-term success favors the humble. Let's apply this outside investing. In career decisions, people overestimate transferable skills. They assume confidence in one field automatically translates to another. Sometimes it does. Often it doesn't. Industries have hidden rules, unwritten incentives, subtle risk factors. If you don't understand those, you're operating blind. And blind confidence is more dangerous than open ignorance. Open ignorance asks questions. Blind confidence makes bets. Munger didn't rush to have opinions. He waited until he had understanding. That patience shrinks your ego, but strengthens your decisions. And here's the key insight. It's not a problem to have a small circle. It's a problem to have an imaginary large one. If your circle is small but solid, you can build wealth. If your circle is wide but shallow, volatility will expose it. So how do you know if you're overestimating? Ask yourself, would I be comfortable explaining this investment or decision under cross-examination? Could I defend it against someone smarter than me in this field? If new information contradicted me, would I recognize it or resist it? If those questions make you uneasy, that's a signal, and signals matter. Circle of Competence is less about pride and more about survival. The market doesn't reward confidence, it rewards correctness over time, and correctness requires boundaries. Most financial disasters happen outside competence. People stretch for higher returns. They chase trends they don't understand. They assume intelligence in one domain applies universally. And eventually, reality draws the boundary for them, usually painfully. The disciplined alternative is slower. You admit ignorance. You avoid what you don't understand. You expand deliberately. You stay small until clarity grows. That doesn't look impressive, but over decades, it compounds. Overconfidence destroys quietly. Humility builds quietly. And in the long run, quiet builders tend to win. That's the real danger of overestimating what you know. Not embarrassment, loss. And long-term thinking cannot survive repeated large losses, so protect the boundary. Know what you know. More importantly, know what you don't. That's where real competence begins. All right, now let's move into the part most people don't want to hear. Staying inside your circle is not just about intelligence, it's about discipline. Because the real pressure doesn't come from confusion, it comes from opportunity. The market is always offering something exciting, a hot stock, a new technology, a once-in-a-lifetime trend, a friend who just doubled their money, a headline screaming urgency. And suddenly, your small, rational circle feels slow, boring, insufficient. This is where most people break. Charlie Munger didn't just define the circle of competence, he defended it relentlessly. And that's the part people underestimate. It's not hard to admit ignorance in private. It's hard to admit ignorance when money is moving without you. Let's be honest, watching others win is psychologically painful, even if you don't understand what they're doing, even if you know it's outside your expertise. There's a voice that says, what if you're missing it? What if this is the big one? What if staying disciplined makes you poor? That voice expands your circle emotionally, not intellectually, emotionally. And emotional expansion is the most dangerous kind because it feels urgent. Let's talk about FOMO. Fear of missing out is not about money, it's about identity. You don't want to be the only one who didn't see it. You don't want to look slow. You don't want to feel behind. So you stretch. You tell yourself, I understand this enough. It's basically similar to what I know. I'll just put in a small amount. But small exceptions create habits, and habits reshape boundaries. Munger understood that protecting your circle requires saying no repeatedly, not once, repeatedly. He and Warren Buffett passed on thousands of opportunities. Thousands. That's not exaggeration. They waited years between major decisions. Years. Now imagine that level of restraint in today's environment, where markets move every second, where social media rewards immediacy, where everyone has an opinion instantly. Restraint feels unnatural, but restraint is the moat. Here's the uncomfortable truth. Most people don't fail because they lack intelligence. They fail because they can't sit still. They need action, they need movement, they need participation. But activity is not progress. Inside your circle, patience compounds. Outside it, activity amplifies risk. And here's another layer most people miss. Sometimes the hardest thing is not avoiding what you don't understand, it's avoiding what you almost understand. The almost zone is dangerous. You know enough to follow the conversation, you recognize the buzzwords, you see the potential upside, but you haven't mapped the risks. You haven't lived through a cycle in that space. You haven't experienced failure there. And experience matters. Because competence is not built from reading, it's built from surviving mistakes. Inside your circle, your mistakes are manageable. Outside it, they can be fatal. That's why Munger favored simplicity, not because he couldn't understand complexity, but because complexity increases unknown unknowns, and unknown unknowns don't care about your confidence. Let's bring this to real life. Think about career decisions. Someone sees AI booming. They don't understand the technology, they don't understand the industry structure, but they pivot their entire career because it's the future. Maybe it works, maybe it doesn't, but if it fails, they don't know why. And if you don't know why you failed, you can't improve. That's operating outside competence. Now think about investing. A disciplined investor studies consumer brands for 15 years. They understand pricing power, distribution, customer loyalty. They know how recessions affect margins. That's deep competence. Then crypto explodes. Everyone around them is making money. The temptation is enormous. And here's where identity pressure shows up again. Am I outdated? Am I too conservative? Is my framework obsolete? That doubt can push someone outside their circle, not because they understand the new space, but because they fear being irrelevant. Relevance anxiety destroys boundaries. Munger didn't chase relevance, he chased understanding. He was willing to look old-fashioned, slow, even wrong temporarily, because long-term discipline matters more than short-term validation. And this ties directly to risk sizing. When you're inside your circle, you can size confidently because you understand downside probabilities. When you're outside it, you're guessing, even if you don't admit it. Guessing with small money is learning. Guessing with large money is gambling. And here's something subtle. People often expand their circle after success. They make money in one domain, confidence increases, they assume skill is universal. It's not. Skill is contextual. Remove context, remove edge. Munger stayed aware of that. He understood that competence decays if you drift too far away from it. So he kept coming back to the same types of businesses he understood deeply. He went narrow and deep. That's the model. Not wide and shallow, deep enough that you recognize when something is abnormal, deep enough that you spot risks others miss, deep enough that patience feels rational, not fearful. The world will constantly test your boundaries. It will reward people temporarily for breaking discipline. It will make restraint look foolish, but cycles always turn, and when they do, the boundary matters. Here's the practical takeaway. If something excites you more than it makes sense to you, pause. If you feel urgency instead of clarity, pause. If your main motivation is not to miss out, pause. Inside your circle, decisions feel calm. Outside it, they feel fast. Calm is underrated. Fast is seductive. And long-term thinking cannot survive repeated emotional decisions. The circle of competence is not about being right all the time. It's about avoiding catastrophic wrong. Because avoiding big mistakes is more powerful than chasing big wins. That's not glamorous, it doesn't make headlines, but over decades, it's lethal in the best possible way. Stay inside what you truly understand. Expand slowly. Defend the boundary. Because once discipline breaks, rebuilding it is much harder than keeping it. And in the long game, the people who can sit still usually win.
Now let's talk about something deeper. How do you actually expand your circle of competence? Because here's the misunderstanding. Staying inside your circle doesn't mean staying small forever. It doesn't mean being rigid. It doesn't mean refusing to learn. It doesn't mean I only know this one thing and that's it. That's not what Charlie Munger meant. Your circle should grow, but it should grow the right way. Slowly, intentionally, earned. Most people try to expand by exposure. They consume more content, read more headlines, watch more interviews, scroll more analysis. That feels like expansion. It's not. That's familiarity. Familiarity reduces fear, but it doesn't create depth. Real expansion comes from structured learning and direct feedback. It comes from doing the work long enough that patterns become intuitive. Let's break this down practically. If you want to expand into a new industry, say energy, you don't start by buying energy stocks. You start by understanding, how does money flow through the system? Who has pricing power? Where are the bottlenecks? What kills companies in this space? What has historically gone wrong? You study failures as much as successes, maybe more, because competence includes understanding collapse. Munger was obsessed with inversion. Instead of asking, how do I win here? He would ask, how do I lose money here? That question forces depth, and depth builds the circle properly. Here's another principle. You don't expand your circle by making big bets. You expand it by making small, contained experiments. Small positions, small projects, low-risk exposure. You gather data. You observe your own reactions. You see what you missed. Because theory feels clear, reality is messy. When money is on the line, emotions show up. When a project stalls, frustration shows up. Competence isn't just intellectual, it's behavioral. You need experience under pressure, and that only comes with time. Time is the ingredient people try to skip, but you can't compress pattern recognition. You can accelerate exposure. You cannot accelerate wisdom. That's earned. Now let's talk about mental models. Munger believed in building a latticework of models from multiple disciplines: psychology, economics, biology, physics. Why? Because the world is interconnected. If you only understand one narrow slice, your circle stays fragile. But if you understand incentives, human bias, supply and demand, feedback loops, your circle becomes more flexible. Not wider recklessly, stronger structurally. For example, understanding human psychology improves investing competence because markets are driven by behavior. Understanding incentives improves career competence because organizations respond to reward systems. The more foundational models you build, the more accurately you can judge new opportunities. But notice something. These are fundamental models, not trends, not hot sectors, not temporary narratives. Fundamentals expand competence sustainably. Trends inflate it temporarily, and inflation eventually pops. Another key point: expansion requires saying, I was wrong, repeatedly. You will misunderstand industries, you will misjudge people, you will miscalculate risks. If your ego resists correction, your circle cannot grow, because growth requires updating. Munger changed his mind when evidence changed, but he didn't change it based on noise. That distinction matters. You don't expand based on excitement. You expand based on understanding earned over time. Here's a practical framework. Before adding something to your circle, ask, have I seen this play out through a full cycle? Do I understand how it behaves in bad conditions? Can I explain the unit economics clearly? Do I know who typically fails here and why? If the answer is no, you're still in learning mode. And that's fine. Learning mode is underrated. Most people want to jump from curiosity to conviction, but conviction without experience is fragile. Now let's zoom out. Why does proper expansion matter so much? Because your earning power and investing power compound over decades. If your circle grows correctly, your opportunities grow with it. You'll see angles others don't. You'll avoid traps others fall into. You'll connect dots faster. But if you expand recklessly, you accumulate hidden risks, and hidden risks explode later. This applies outside finance too. Relationships, business partnerships, health decisions, career shifts. Expanding into areas you don't understand without groundwork creates fragility. Doing groundwork creates leverage. Munger didn't rush expansion. He read constantly, across disciplines, for decades, and slowly his circle became massive, but still defined. That's the key. Large doesn't mean undefined. Even late in life, he openly said there were industries he simply didn't understand well enough. That humility never disappeared, and that's the final piece. Your circle grows best when humility remains constant. The moment ego replaces curiosity, growth stops, because ego assumes it already knows. Curiosity asks better questions, and better questions expand the circle intelligently. So here's the takeaway. Stay inside your circle today. Expand it deliberately tomorrow. Use small experiments. Study failure. Build foundational mental models. Seek disconfirming evidence. Update without ego. And accept that real expansion takes years, not weeks. That's not exciting advice, but it's durable advice. In the long game, durability beats speed. Every time. Your circle of competence is not a cage, it's a structure. Build it carefully, reinforce it slowly, and over time, it becomes one of the most powerful advantages you have. Now, let's bring this home. Because all of this, boundaries, humility, discipline, expansion, sounds good in theory, but what does it actually look like in real life? What does the circle of competence look like over decades? This is where most people misunderstand Charlie Munger. They think the idea is about limitation. It's not. It's about survival first, then compounding. Here's the truth that doesn't get enough attention. You don't need a huge circle to build extraordinary results. You need a small circle with high conviction and the discipline to stick to it. That's it. Look at how Munger and Warren Buffett operated. They didn't invest in everything. They didn't chase every innovation. They didn't rotate aggressively between trends. They didn't constantly reinvent their strategy. They focused on businesses they deeply understood: consumer brands, insurance, simple cash-generating machines with durable advantages. And they waited, sometimes painfully long, years with little action. Imagine telling modern investors, we're going to do almost nothing this year. That sounds lazy today, but in reality, it's extremely hard because doing nothing requires confidence in your framework. It requires emotional stability. It requires ignoring noise. And here's something powerful. Inside your circle, patience feels rational. Outside it, patience feels risky. When you don't understand something, you feel pressure to act, to prove you're engaged, to prove you're not behind, to prove you're capable. But when you truly understand your domain, you know opportunities repeat. You know cycles come back. You know you don't have to swing at every pitch. That calm is earned, and calm compounds. Now zoom out. Most financial destruction doesn't come from one big mistake inside someone's expertise. It comes from stepping outside it. The tech investor who suddenly trades commodities, the real estate expert who speculates on biotech, the operator who over-leverages into an unfamiliar sector. The pattern is always the same. Confidence transfers, understanding doesn't, and that gap is expensive. Munger's brilliance wasn't just intelligence, it was self-awareness. He knew what he didn't know, and he respected that boundary. Respect is the right word. He didn't mock industries he avoided. He didn't pretend they were stupid. He simply said, "It's outside my circle." That sentence alone could save people millions, but ego hates that sentence because outside my circle feels weakness. In reality, it's strength. Here's another layer. Your circle defines your edge. If everyone understands something equally, there's no advantage. But inside your circle, you see details others miss. You recognize subtle signals. You interpret data differently. Edge lives in familiarity plus depth, not novelty. And here's the irony. The world constantly pushes novelty, new technologies, new platforms, new financial products, new narratives. Novelty grabs attention, depth builds wealth, and depth requires repetition, the same industries, the same frameworks, the same patterns studied over years. That sounds boring, but boring is often profitable. Now, let's apply this personally. Think about your own skills. Where do people consistently ask you for advice? What problems feel intuitive to you? Where do you see mistakes instantly? That's a clue. Your circle isn't defined by interest, it's defined by demonstrated understanding, and understanding is proven by results over time, not by confidence, not by opinion, results. Munger once implied something powerful through his actions. Avoiding stupidity is more important than seeking brilliance. Inside your circle, you avoid obvious stupidity. Outside it, you're guessing, and guessing introduces avoidable risk. If you can simply avoid major mistakes for decades, compounding does the rest. That's not flashy, but it's brutally effective. Now, here's the final mindset shift. The circle of competence isn't about shrinking your life, it's about structuring your decisions. You can explore widely, read broadly, study different fields, stay curious, but you allocate capital, financial or emotional, only where understanding is deep. Curiosity can be wide, commitment must be narrow. That distinction protects you. And over time, as your understanding deepens in new areas, the circle expands naturally. Not emotionally, not socially, not out of envy, but because it's earned. That's sustainable growth. And here's the quiet advantage. When you operate inside your circle consistently, people begin to trust your judgment because your decisions are coherent. You're not constantly switching narratives. You're not chasing headlines. You're stable. Stability attracts opportunity. Volatility repels it. In the end, the circle of competence is less about investing strategy and more about identity. Are you someone who chases or someone who understands? Are you someone who reacts or someone who waits? Are you someone who expands through ego or someone who expands through mastery? That choice determines everything, because over 30 or 40 years, small edges compound massively, and small errors compound painfully. Munger didn't win by knowing everything. He won by knowing enough, deeply, and ignoring the rest. That's the lesson. Know your circle, defend it, expand it slowly, respect your limits, and let compounding work. You don't need to be everywhere. You just need to be right where you truly understand. And over a lifetime, that's more than enough.
All right, let's close this properly. Because the circle of competence isn't just a concept, it's a filter for life. Not just investing, not just business, life. And here's the part most people never connect. Your circle determines your stress level. When you operate inside what you truly understand, decisions feel grounded. You may not always be right, but you know why you made the decision. There's logic behind it. There's structure. There's process. Outside your circle, decisions feel louder, more emotional, more urgent. You check prices more. You seek reassurance more. You second guess more. That's not random. That's your brain telling you something. You're in unfamiliar territory. And most people ignore that signal. They override it with optimism or ego or social proof. But over decades, that constant tension adds up. This is why Munger valued rationality so highly. Not brilliance, not speed, rationality. Rationality is calm thinking inside known boundaries, and that calm gives you endurance. Now let's zoom out even further. What destroys long-term compounding? Not small mistakes, big ones, permanent ones, the kind you don't recover from. Over-leverage, overconfidence, overexpansion. All three usually happen outside someone's circle.
Inside your circle, you understand downside risk. Outside it, you underestimate it. And underestimating risk is the most expensive mistake in the world. Here's something subtle but powerful. The circle of competence gives you permission to ignore things. Think about that. Permission to ignore. That's freedom. You don't need an opinion on every new technology. You don't need to comment on every market move. You don't need to participate in every opportunity. Silence becomes strength. Selective participation becomes strategy. In a world addicted to reaction, that's rare. And rare behavior creates rare results. Now here's the deeper philosophical layer. Knowing your circle requires self-honesty, real self-honesty, not performative humility, not fake modesty, real assessment. What do I actually understand? Where have I proven judgment over time? Where am I simply echoing others? That kind of questioning is uncomfortable because it exposes ego. But ego is expensive, and the older you get, the more you realize protecting capital matters more than proving intelligence. Munger never needed to prove he was smart. His results did that. And the results came from discipline, from boundaries, from decades of consistency. Let's make this practical. If you're early in your career, your circle might be small. Good. Keep it small. Go deep. Depth builds confidence that lasts. If you're mid-career, your circle might be clearer. Double down, refine it, strengthen it. If you're experienced, your circle might be wide, but stay honest. Don't let past success trick you into reckless expansion. Experience is an asset. Overconfidence is a liability. Now here's the final mental shift. The goal isn't to maximize activity, it's to maximize intelligent allocation of money, of time, of attention, of energy. Your circle tells you where allocation makes sense. Everything else is noise. And noise feels productive, but it rarely compounds. Inside your circle, you build a reputation. You build pattern recognition. You build judgment. Outside it, you build volatility. So the question becomes simple. Do you want excitement or durability? Excitement is immediate. Durability is exponential. Munger chose durability over and over again. And over 50 years, that choice created extraordinary results. Not because he knew everything, but because he knew enough, deeply, and ignored the rest. That's the discipline. That's the edge. That's the philosophy. Know your circle, respect it, expand it slowly, avoid catastrophic mistakes, let time do the heavy lifting. Because in the long run, the person who avoids stupidity, protects capital, and thinks clearly inside their competence wins more often than the genius who chases everything. And that's the real power of the Circle of Competence. Simple, uncomfortable, relentlessly effective.